Hey everyone, welcome to the graph plus the lines tutorial. This is one of our most important things. You're going to be looking at this day in and day out. This is the actual graph. Now you can see it kind of looks a little bit confusing now, but after this tutorial, it will make a lot more sense. So first things first, how to actually move the graph. You can either drag and drop it anywhere, use your mouse wheel, or use these numbers down here below to actually use it. If you're working on a laptop, I found it's easier to actually use these buttons here that you can just zoom in or zoom out or auto scale or reset everything. This goes for absolutely every single one of our graphs. Whenever you hover over one, you will be able to see all of these little buttons that you can zoom in or zoom out of anything. With that being said, let's start the tutorial. So first things first, you have your bull and your bear trigger. Typically, whenever the price passes one of these levels like this one, you would either buy or you would sell. So if it goes up, you would buy. If it passes this, you would sell towards the first target. However, you don't always enter when it's a bull or a bear trigger. For example, when they are very close to a VWAP or a POC. So like this bull trigger right here, you're super close to this VWAP, so it's maybe not the best idea to actually enter because this is another very important level. Another reason is you don't enter in the bull or bear trigger is if the indicators aren't confirming the actual movement. Next up, you have your VWAP. The VWAP is the line that shows a special calculation that is the fair price of the market. Everyone, absolutely everyone, banks, institutionals, big players, etc., they all understand that below this line right here, below this blue line, the price is cheap, and above this line, the price is expensive, and they use that calculation. The VWAP is also very important because thousands and thousands of robots are actually waiting for the price to cross this line so they can buy and sell. This line has a very strong liquidity following it. So it takes a lot of orders, a lot of liquidity, a lot of very big movement for it to actually break through this line and not bounce. Why is the VWAP important? Well, it's the same for absolutely everybody on every single time frame. It's the same for me. It's the same for JP Morgan. It's the same if I'm working in a 5 minute to an hour time frame. So there's thousands and thousands of traders and bots buying and selling at the same time when it hits the VWAP. So it's a good time to either exit or wait for a bounce. Again, the only time there's a break on a VWAP is when the liquidity levels of the movement is super high. Because so many people have orders on the VWAP, it has to consume all of those orders, all of that liquidity to actually break. So that's why we wait for it to bounce. Next up, we have our targets. So you see we have our bear targets and our bull targets. We have three of them: bull, 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 bear, 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 bear. You should take profit on most of the targets most of the time because there will be bounces. So if the price goes up to this first target, you should take your profits because realistically, there's bound to be a bounce because it's a level that has a lot of interest. On some occasions, it'll actually break and go straight to the next level. Other times, it'll break the level and then retest it. So it'll either break and go straight to the next one, or it'll break, retest it, and then go to the next one. So it depends on your strategy whether or not you want to exit on the first target, on the second target, if you want to exit the first time it touches, or if you want to wait for it to break and retest, or if you want it to break. It just depends on your own personal strategy. The flip area. The flip area is where the market goes from positive to negative gamma. It is also serves as a support and resistance level depending on where it is. So right here, if the price goes, it serves as a support level. If the price is under it, it serves as a resistance level. Going on to our N2 graph, you can see a couple of more. So I want to talk about this right here, the POC. The POC is important because it shows us the level where there has been the most trades, the most buys and sells throughout the day. It's a magnetic level and a bounce level because of its high liquidity. So we use this to usually exit trades. Prior settle simply means this is where the market settled the night before. ATM, so you have your minimum ATM plus your maximum ATM here. ATM means that's where the market wants to trade between if the market is neutral. So if the market is neutral, it'll usually stay in between these levels. Then we have ITM and OTM. OTM and ITM means that's where the market will go if it's under stress, meaning if it's a very extreme bull or bear market. Then we have our hedge wall right here. The hedge wall has a lot of interest and liquidity. So whenever it touches the hedge wall, it's very usually a bounce. And that's it for the graph and line tutorial. Again, you can either drag and drop the graph or use these buttons to zoom in or zoom out. These graphs for the NQ, for the SPX, for the ES all work the same way, and most of them have a lot of similar levels.